1997, the Kyoto Protocol for the first time committed nations to reduce their greenhouse gas emissions. Since then, the Carbon Disclosure Project aims to practically reduce these emissions by assisting businesses to comply. This ultimately culminates in businesses being listed in the Carbon Performance Leadership Index, a collection of companies who are the leaders in transforming their businesses for a greener future. But how well do these businesses perform when it comes to investment performance? I welcome my guest hosts today, of course, Nerina Visser, Kobie and Roland. Great to have you with me. Okay, so let's get into the topic of the week. Let's kick off with a comment around green investment. And Nerina, I'll start with you. In 2012, does green investing have more significance today?
I think absolutely. You know, not just in South Africa, but certainly internationally, we see this as a very strong developing trend. From the South African point of view, I think this was probably initiated by the establishment of CRISA, the Voluntary Code for Responsible Investment in South Africa, to which most of the asset managers and many other industry participants subscribe and take part in. But then, of course, also the changes that we saw to Regulation 28 of the Pension Fund Act requires that pension funds in particular take account of ESG factors, environmental, social and governance. And this is a specific requirement that has now come about, and I think the focus therefore is on the entire investment process and how you incorporate those into your decision making.
It's about risk and adjusting for risk and understanding broader risk environment. Kobie, let's get your views and take a step back into how we've seen an evolution in the approach to firstly factoring in the environmental factor and what role Kyoto Protocol has played, and then of course what role the overall climate change negotiations have played in this space.
Look, I mean, I think that green has come a very, very long way since 1997. You know, Kyoto was kind of seen as a starting point to being green, but it was kind of seen as something extra that you might want to add on down the line, you know, maybe in investment decision making. It wasn't something which you wanted to take seriously, and I think that since then the world has come a very, very long way.
From an asset manager's point of view, not something you wanted to take seriously.
Well, I mean, back in 1997, who wanted to take green, you know, seriously? I mean, certainly Kyoto made some important findings, and they bound nations to some very specific reductions. But who wanted to take that seriously from an investment perspective? You know, you kind of invest for risk and return, and you kind of thought about that. Whereas today, if you look at the Carbon Disclosure Project, I think that's taken it a step further, and it's kind of said, well, if we don't do something about this now, and we don't become green now, there's not going to be a future. I mean, if you look at a visual that we've put together, you'll see the Carbon Disclosure Project, and you'll see that the scoring methodology and how that specifically looks for the Carbon Disclosure Project. And you'll see that if you score above 70, well, you've got a whole bunch of senior management that understands business issues, and they relate to how they relate to climate change, and you're at the forefront of development in that space. And then below that, you get to what's called mid-range and low scores. Low, it means limited or restricted ability to measure and disclose at the end of the day. And if I just show you globally who some of the companies are that kind of score very highly, and I mean, this is not a finite list. There's a whole bunch of other companies as well, but this is predominantly some of the biggest scorers. You can see some companies there: Philips Electronics, Bayer, Cisco, Tesco. I mean, and this doesn't mean none of these people don't actually emit. It just means that they've put plans into place in order to make sure that that they could potentially reduce that in the future.
Roland, when you saw that list, what stood out for you from the names that are the top performers when it comes to the CDP?
Well, I think the big brands are very clearly having to show their clients that they are being responsible, other than financially and in terms of management, but in terms of the things that happen outside of their company, or the things that they do that impact what happens outside their company. So simple things like packaging and those kind of things we all consume a lot of, but we didn't really care about that in the past. I also think it's important to mention that the issue around risk is very important, because we have, and I'm certainly guilty of that in my industry, looked at risk purely from a volatility perspective, or from a risk factor modeling perspective, which is very much financially specific. What we are now looking at is risks beyond investment, which is, you know, are we going to actually be able to live on the planet in the next 100 years?
Exactly.
So we need to factor that into our decision making when it comes to investing, and that's opening up a whole new way of defining what risk is. And it's not about financial or price risk or downside risk or volatility. It's about are we actually helping or making progress? And in order to do that, you need a benchmark. And I think that's where we are right now in the investment spaces. We're creating new and new indices and benchmarks that allow us to actually measure progress. Because if we don't have a benchmark, we'll never know if we're actually moving ahead in this space.
Do we have a benchmark right now that you can look at?
Well, we've got codes and these kind of things that people and companies are trying to adhere to. But I think on the investment side, and this is sort of the work that Narina's been doing, we're starting or scratching the surface really in terms of providing an investable benchmark rather than just a company and socially kind of responsible thinking when it comes to managing companies.
I think the Reg 28 really stands out in terms of changes to the regulatory environment. Now, pension funds are mandated to take and adjust for the risks that are attached to environmental, social, and governance factors, and they have to adjust for that and understand it. What are your views on how to do this, though? How to quantify those risks?
Well, I think Roland raised a very important point in terms of managing risk, and I think probably the word that stands out most for me in this is the sustainability argument. And of course, sustainability is something which is associated very well with environmental issues, but from an investment point of view, it is so incredibly important to also ensure that you are investing on a sustainable basis. And I think it is that particular aspect that is brought into Regulation 28, and that they are particularly keen to make sure that all participants actually take this into account.
What has been the response from the asset management community? How tough is it for them to get their head around this new regulation and this new mandate in terms of quantifying these broader risks?
Well, you know, Samantha, I think it's still in its infancy. And I think that a lot of what's happening in the asset management industry, it's still on the periphery of the asset management society. And I think a lot of people are starting to taking cognizance of this, predominantly because legislation is forcing them to do so. But I think that, I think you're probably going to see that for the next 5 years. I tell you what's difficult to ignore, though, and that is that if you look at the returns for the green index, which is now we're talking about the B green index, and we look at the performance of that long term relative to some of the other indices, it becomes quite difficult to ignore. If you look, you'll see what I mean, and there you can see it on your screen. This is now rebased to a common starting point of 1,000. And what you're seeing over here is you see the B green index right at the top end of the screen there, and you can see the returns, and that's relative to the all share index in light green, relative to the social responsible index of investing run by the JSE. And there you can see some of the returns there, 13.9% per annum versus 5.9 and 2.9. And then on a risk basis, it's actually reduced some risk as well. So it seems like being green means that you potentially can create some returns at the same time.
But are the clients going to drive this, or are the asset managers going to drive this? In other words, both of you maybe can shed some light on that. In other words, the asset manager is not going to change their thinking or their portfolio construction until the end investor, the pension fund,
changes.
Or the mandate changes. Is that true, or are fund managers being proactive here and actually saying we need to change our investment philosophy? Because that's quite a big change.
I think there are two schools of thought. The one is the school that says we're doing it because it's the right thing to do and because we actually believe in the long-term sustainability and the requirements of ESG. But then there are also others that are increasingly acknowledging the positive financial and therefore investment benefit that investing in environmentally conscious companies actually have. And I think it's in particular there that we find it very interesting to look at. I'd like to use an example of one of the global leaders in South Africa being Gold Fields. Now, so many people look at the mining industry and say, how on earth can a mining company be a global leader in terms of environmental sustainability? But let me just use one example of a project that they have at their Beatrix gold mine. At this mine, what they have is a situation with methane gas, excess methane gas at the bottom of the mine, which of course is very unstable, and it is also very dangerous for the workers.
And a lot more poisonous than normal carbon.
Yes. So what they do is they actually extract that from the mine. So first and foremost, creating a safer mining environment, lot less chances for explosions and so on. So they're actually improving their productivity and their turnover targets. First level of financial performance improved. The second thing is that they then take that extracted methane gas and they actually use it as an alternative source of energy. This has reduced their dependence on Eskom, including the cost line, of course, as well. So you can see a second financial line where they're getting direct benefit. And then the third level is that the United Nations actually gives Gold Fields credit, carbon credits for what they are doing there. And a carbon credit actually has a monetary value. So Goldfields can sell that and in the process actually increase their revenue. So you can see how doing the right thing actually has an immediate and direct benefit on the financial
business model. They're not changing perhaps the fact that maybe further down the road they might be polluting into the water, but yes, they're building a plant where they're extracting the methane, selling the carbon credits, earning money off of that. So how do you evaluate those two factors? Because they're still a minor ultimately, and they're still perhaps having negative environmental impact further down the line in other parts of their business.
Yeah. I'd like to address two sides there. The one is, of course, that as a business, just as a company, yes, of course, they still have an emission and they still have an impact. But unless you actually address it at the biggest polluters, you can't have a chance of actually reducing the overall emission levels of a company like South Africa. But from an investment point of view also, if one were going to be quite narrow-minded and say, I'm only going to invest in those companies and industries that are already carbon neutral or clean, you probably will end up with a very concentrated and inappropriate investment vehicle, because you won't have the diversification of a range of sectors and industries in which to invest. So from both those points of view, we do believe that it is important to incorporate on a measured basis the dirty industries as well.
But who measures what the company does and how well they're performing? It's not you, right?
No, certainly not. No. This is done by the Carbon Disclosure Project, a UK-based not-for-profit organisation, and comes with very good credentials and certainly has got the best independent corporate database in the world in terms of climate information. Now, for the 2011 survey, for example, not only were clients and companies required to actually submit and disclose their practices, but it had to be independently verified by a third party. So their stated intention of carbon emission reduction and how well they fared in terms of that was measured by an independent third party.
You see, I think the important thing here is that think about mining, or any industry for that matter, 100 years ago. 100 years ago, you saw a piece of land, you thought there was gold in the ground, or you thought there was whatever metal you thought was in the ground, and you said, guys, start digging and let's see if we can get something out the ground. And people said, well, what do you want to do with the excess that comes out the ground? No, don't worry about that. You know, it doesn't matter. You know, that environment has changed completely. That way of doing business is completely changed. And we are literally living in an age where it's becoming more important that we no longer look at the past, but look to the future and say, oh, how we can be green.
Are miners and heavy polluters really being held accountable, though, for their actions? Well, what are your views? Because there are mixed views on this, and there are still heavy polluters. For example, I'd just like to bring Sasol into the argument, a second largest polluter in South Africa. Until you have a carbon tax and it's going to hit their bottom line, surely there's not that incentive to change fundamentally.
Okay, but that's the next step, I think, from my perspective, and I think Nerina must talk about this as well. The next step is that people will say, or regulators will say, well, we've given you enough time to comply. We've given you enough time to swing your business. Now we're going to give you a 6 months or a 12-month window. If you're not at these levels, then we're going to start penalizing you from a tax perspective or whatever that might be. Now, that's the next step. So at the moment, this is a whole shift towards being green. And people are, you know, over time complying. And that's where those scores really come from. Hey,
exactly.
The CDP scores.
Yes. They certainly become more stringent every year also. So it's not just the case of, oh, we've achieved the targets, now we can sit back and relax. In order to remain a global industry leader, you've actually got to up your game every single year. And to talk about Sasol, for example, yes, Sasol is in the Nedbank Green Index, but if you look at the performance scores, which is really what determines the weight of a company in the index, they're only at a level C. There's A being the global industry leaders and D being the guys that really are just starting their journey. Sasol is scoring a C, which is certainly not a great performance, but they are better than many other companies out there, and certainly in terms of a global industry basis in terms of oil.
Sorry, they're not just looking at listed companies, these inspectors who go and judge whether a company is complying or not. They're looking at Eskom and those kind of companies as well. They also get a green score. It's just that they won't be part of an investable index.
Yes, and there are certain aspects of the survey which is only applicable to listed companies. So yes, they do that, and for that matter also they incorporate some smaller companies as well. So it's not just restricted to the top 100 companies, listed companies that we include in our green index, but it really does look at the comprehensive exercise of covering the entire industry.
You know, I think it's important that we look kind of at maybe just how the construction looks of the B Green Index, and maybe just some of the factor models that kind of just play into that space. Have a look maybe at your screen at the moment. You'll see the B Green Index, and as a matter of fact, this is what the Nedbank Green ETF is actually based upon, and we're going to talk a little bit later about that. But just look at the index there, and you can see some of the large constituents. There is a top 10 holdings as far as companies are concerned. And you can see the weighting as far as those companies are concerned. And you can see the weightings there relative to the social responsible index, which is next to it, the all share index, which is a J203, and then the SWIX, which is the shareholder weighted index. And you can see how those kind of look. And you can see there's some big resource companies in there. Woolworths is in there, Remgro, Goldfields, yes, certainly
okay,
some mining companies
before we
in there.
take a break and we look at some of those individual companies, because as you say, Goldfields makes the top of the list when it comes to the green ETF. Can we trust companies right now that they're doing the right thing? Can we put our trust in these big top 40 companies that they're taking it seriously? We're going to put our money in them, and 10 years down the line, they've identified the risks around water and pollution and carbon taxes?
Well, the only way to do that is to have a benchmark and to have some kind of goal system that we can measure them on. And that's what these projects and code of conducts are trying to do. And what this green index is trying to do is trying to actually weight the stocks in such a way based on their score. So until we can actually tangibly see people going up or down a ranking, they then start realizing that they're not complying or that they are complying. So you're providing people with an incentive to do this, and without that it won't work.